and welcome to Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches here in sunny Sydney and around Australia on the Community Radio Network through the Community Broadcasting Association of Australia. I know it's a bit of a mouthful, ladies and gentlemen, but it's really nice to have the regional stations out there, and I get the occasional email from Mount Armidale and Dalby and a few other places out there. So thank you. We really appreciate that you're out there. Sometimes I guess you wonder if anybody's actually listening. You see the stats, but it is kind of nice that we get the odd occasional communique. So please keep them coming in. We've had a lot of response, ladies and gentlemen, to the superannuation series and the Div 296. So those of you that aren't aware, that's just gobbly, finance speak for the extra 15% tax that's been looked at for balances over $3 million. Now, most of us would sit there and go, gosh, if only, we'd love to have a balance over 3 million. And again, there's been a number of issues, and I've got today with me Michelle Griffiths from TAG Financial Services, who's been on before. Now, Michelle, you are one of these excellent mixtures of qualifications, because not only are you a financial planner, you are also a chartered accountant. And I've got to say you're a rare breed in that regard, not to boot that you're also female in a very male-dominated industry. And I really enjoy having many more females coming onto the show, because it ends up being a sad thing that there's more than 50% females once you get past sort of 70-odd years old. And so it's something that's becoming increasingly observant as I age. So welcome to the show, Michelle.
Thank you, Ray. It's great to be on again. And it's great to be able to address this topic, because it has been getting a lot of play in the media. I think there was a week, it was a couple of weeks ago, and there was literally in one of the major newspapers 6 different articles on this one topic, all from different angles and different writers and taking different tacks. But it's clearly something that a lot of people are worried about and that is getting a lot of airplay. And I think there's a lot of fear-mongering been going on. And I think being able to make our way through it, understand what it is, and actually kind of get over the whole, I'll call it, whinging about the fact that it is or it isn't, or what it's going to be or what it's not, and actually start to think about, well, strategically, what do we need to do about it? I think that's probably where we are now. We're done with the complaining. Let's just get on with it and work out what we need to do next.
And I think it's good to pass out some of the issues at hand, because I don't necessarily want to try and flog a dead horse on today's show. And talking about strategies of dealing, with the laws as they move forward, because I've had Natasha Panagis, I've had Stuart Cherry from IFPA on, I've had a number of experts talking about, and I think the biggest issue that certainly I have as an industry pundit and as a licensee myself is taxing of unrealized gains. Now, neither here nor there about whether it applies here or elsewhere. I think the basic premise is flawed and shouldn't be done. That aside, I think the more poignant issue is about taxing sums over $3 million. And I think, Michelle, one of the things that I keep harping back to is one of the things that Albanese 1.0 did was legislate the purpose of superannuation. And I think this is where much of the hyperbole that's going on right now tends to get lost in the fray, where I keep on coming back to, guys, when superannuation was first devised and when it was guaranteed in legislation in the 90s by Paul Keating and beyond, there was a specific purpose. And I think, please agree or disagree with me here, that it's been, I think, prostituted a bit and not doing what it's supposed to do. And so by legislating the purpose, I think we've got a lot more clarity, and I'd like to talk about that today. That's what we're talking about today as well, do you think, Michelle?
Absolutely. I think you're right. I think having Australians being able to own their own, I'll call it, financial future, and actually be incentivized to be able to use your own money in a safe environment and taxed effectively. The superannuation system is renowned in the world for
It is.
how forward thinking our
It
Australian
is.
system is. So I think we shouldn't lose sight of the fact that it's actually doing a really superb job. It's just that I think when the government needs some more money, they're obviously cash strapped. It's a pretty easy target to look at people who have got the more than $3 million. Now, whether that number finishes up being 3 million or 2 million, I think there's still a bit of argy-bargy going on there. But as soon as you get beyond a certain amount, for it to be less tax effective is essentially what they're trying to achieve, because it's supposed to be an equaliser.
And again, when I go to various forums and listen to investor get-togethers, and they're all up in arms and going, they shouldn't be doing this, and I just politely remind them, because it ends up being a left versus right kind of discussion. I end up reminding them, excuse me, but it was the LNP that brought in caps on superannuation, not Labor. Okay, they are the party that brought in the 1.6 million cap, and they are indexing it. So let's get some facts out there. And
Absolutely.
again, I keep harping back to the purpose of super is to provide comfortable retirements. And again, I end up having these really rabid discussions with people, and I'm looking at them going, it's not meant as estate planning and intergenerational wealth transfer. That's not what super is about. Super is for you and only you. And I mean, I've got to tell you this story, Michelle. I was meeting with one of my investors just a little bit into tax year, giving an update on what the fund is doing, because I'm a fund manager, blah, blah, blah. And all of a sudden, I've got a guy that was sitting in the cafe, decides he wants to join our conversation, and it got argy-bargy. And my client actually said, excuse me, do you mind? And told him to go away. But it's just one of those things that I think, and in the notes that you've talked to me about, when we're talking about proactive strategies, I really like your first point there, where value is best held inside or outside of super. And I think that's a great starting point. So what are your views on that, Michelle?
Well, this is probably even before the $3 million concept came into play. There are circumstances where it's actually not as tax effective to hold your money in superannuation, believe it or not. So I think people have been obviously shaken up by this new rule and the $3 million threshold and what have you. But I actually think that this should have been getting thought about beforehand. This is actually just sort of bringing it to the fore, bringing it into people's line of sight, which I think is a really good thing. We have a number of clients where once they're over the, let me call it the $2 million or whatever they can have in pension mode, there are instances where they're better off with those excess monies actually out in their own names for a variety of reasons. One is tax. The other can be estate planning. It could be that they simply don't need that money anymore. They might have more than adequate funds to be able to do everything that they want to do, in which case it then opens up a discussion about, well, how do we support the next generation to maybe get some investment journey underway so that they can start learning about investments and investing and employing the right specialists to help them, so that when they actually do finish up receiving a fairly significant inheritance, because even without super, the house that's owned by mum and dad is usually a significant asset, and therefore the amount of times we've had the children of these people receive these fairly significant inheritance and essentially almost have a panic attack about what now? We are so unprepared for this. We've never thought about this. So being able to actually use excesses or whatever to start that journey in a nice, safe, manageable way so that they can learn about some of these things is actually a really good strategy as well. But it all depends on the family dynamic.
Every family is going to be different. And yet again, I come back to, and I hand wrote some notes here about, family trusts and testamentary trusts and the like. And again, we harp back to what was superannuation originally designed for, and is it serving its purpose? If, for example, you start putting the business or the family farm into a superannuation vehicle, I scratch my head and go, who the hell's been advising you to do that? Because they're mesmerized by 15% tax instead of marginal rates of tax. And it's like, guys, you're going to create so many headaches. And this is where poor advice or no advice,
yes, indeed,
is occurring. And I think because you are a day-to-day practitioner, Michelle, you must be seeing this more often than I think you'd really like to, correct?
Absolutely. And probably the other thing is understanding the different nuances about where you can get advice from, because the reality in this situation is there, and this is, and remember, I'm an accountant, Ray, so I can say this with complete respect for my profession. Accountants, generally speaking, will be looking at things either in the year that's gone or 1 year ahead, because that's what they've been trained to do. It's very much a, how does the tax work now? Now, that approach, when you're looking at these types of decisions, is probably not really the right approach to take, because you need to be looking at these types of decisions with sometimes decades in mind. So being able to project forward, to be able to think about this in terms of what might this look like in 5, 10, 15 years' time? How is this going to affect the next generation when they receive it? Are we having them receive it in the right way? These are things that are not decisions that, quite frankly, your accountant is really that qualified to answer these questions. So it's really about understanding the parameters where your accountant's advice is actually really important to a point. And then there's some of these more futuristic or longer term thought processes that sometimes this is where your financial planner, if they're a holistic financial planner, that's where their value really comes to the fore.
I think you've made some great points. Look, we're just about half time. We're going to, we're on Dollars and Making Sense, a weekly show about finance, money and investing. I'm here with Michelle Griffiths from TAG Financial Services. We're talking about all things to do with Div 296 and where, what's the next step. We're going to take a short break and be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money and investing. I'm really pleased to have at the microphone in Canberra this week, Michelle Griffiths from TAG Financial Services. Michelle is a chartered accountant and a financial planner, which I think is a great mix. I'd love to see more of that, I've got to say, out in the big wide world. Now, we've been talking about the $3 million additional tax that's being potentially legislated by the Labor government that's coming up. And not just the hyperbole around, oh my God, there's a tax, what are we going to do? I think, we're talking about what is the right strategy going forward. Now, before we went to the break, Michelle, you made a really good point that tax people think about the current year and maybe the next year, whereas financial planners think long term, and we're talking 5, 10, even 15 years. And I guess we've had such a degradation of numbers of financial planners. We used to have 36,000 when I became a planner 8 years ago. There's about 12,000 now. We lost another 2,000 last financial year. So there aren't many there. And the ones that are there charge because they need to for compliance and a whole range of different reasons. And they have a lot of clients. So I guess, Michelle, one of the things that's a curiosity to me, when families, whether through estate or through fortune or whatever, are lumped with $3, $4, $5 million assets, why is there a reluctance to pay a financial planner $5,000 to give them expert advice? What's going on there?
I think there's probably I guess there's an element of not feeling like they're wasting money. I think there's this fear of wasting money. But I think if they're talking to the right financial planner, I know one of the things that we're basically, one of our catch cries is, if we can't actually add value by more than what our fee is, we're not even going to quote you for a number. I think that's probably where we think that way because we've got the accounting and the financial planning. So it is a slightly different way of thinking. I think the other thing is that people fear that as soon as they start talking to financial planners, that the financial planners are going to charge them a percentage of their assets, as opposed to understanding what the fee is and actually having a hard number or a fixed price that they actually can attribute value to. So I think there's a misunderstanding of how it can work. And maybe they've seen planners that actually do charge on this percentage of fees basis. And I was talking to someone literally the other day and they were like, this planner was going to charge me not just on the assets that they were going to manage, but also on the term deposits that I was managing myself. And it's like, yeah, that's just not right.
Well, I mean, people aren't silly and they see that for what it is and walk.
Exactly.
I think people are more than happy to do so. So let's focus now on looking ahead. So part of the notes that you sent through to me, and I really like reading them through, is it's not about reacting, it's about thinking ahead of the curve. Now, again, there's a lot of hyperboles, a lot of media coverage there, and I think dispelling some of the hyperbole and just getting back to some bare basic facts, when people are talking about a 15% tax on amounts over $3 million, it's not as much as people think. I mean, we went through this with Stuart Sheary at IFPA, and he did the actual numbers on $1 million over. And I think the number actually came out to be $15,000. It wasn't as much as people were clucking and, the sky's falling. It wasn't the case. Yeah. So what are the kind of things, and I think the appropriate vehicles we were talking about before we went to the break, what are the kind of things that you're putting forward to your clients as you talk to them about these challenges?
Absolutely. And I think partly it does become a decision of, well, is it actually that much of a problem? Because if they also have other assets that are already outside of superannuation as well, and they're already generating some income from those other assets, there's an argument to say that actually having it inside the super fund may actually be 6 of one, half a dozen the other. It's very similar as far as an end result goes. So when you're looking at it as a year by year thing, it might be that it's so immaterial that it's not worth getting worried about. And this is probably where having that longer term approach and using this as an opportunity to sit back and go, okay, I'm such and such age. Let's just say, for example, I'm over 70. Maybe this is an opportunity for me to revisit what I want my end goals to be, because it's now starting to become a lot more real. This is simply a great opportunity to start saying, well, yes, I'm going to be paying 30% now tax on the earnings inside super, which is not that much different if I had it outside and maybe I had a family trust or a company and I could cap it at 30%. But is there another element, being the death taxes, that I could plan for better by actually taking it out of superannuation now and putting it into this company structure as an alternative, or into my own name? So this is where it's not just about the year by year, it's about looking at those bigger pictures. I was looking at someone the other day and the strategic decisions actually finished up not being important at all, the annual tax, because the annual tax literally was not very much different between the two scenarios. But what really clinched the decision was their desire for legacy and for their kids to get as much as possible in the most tax effective way possible, in which case it then became, well, maybe pulling the excess out of super, putting it into either a company or their own name, depending on how much other assets they've got outside of super, and then making sure their will is recalibrated because we now have a fairly significant shift in where the wealth is. So if you've got blended families and you've had a situation where the new spouse was going to get all the superannuation because that was really tax effective, but we're now pulling half of that superannuation out and put it into your own name or into entities that you control, that estate plan needs to be revisited and tweaked, or potentially just start again in order to make sure that the end result that you want is still happening in this new world. So there's this element of there's things that your accountant can talk about in relation to, well, here's what the tax implications are. That's very factual information. What we're talking about is, what are your goals and objectives? What's most important to you? You can have, I see so many times, and I love this saying, is you can have it cheap, you can have it quick, or you can have it accurate, but you can't have all three at the same time. This is a little bit the same. You can have it tax effective, you can have it be all in superannuation, but it might not actually achieve all of your objectives. So it's about trying to find all of these different elements and putting it together in a way that tries to tick as many of your boxes, but knowing what is most important to you is critical, that decision. Your tax agent or your accountant, generally speaking, they always just go to the tax cost. Sometimes the tax cost is actually not the most important thing.
It's fascinating. I was taking some quick notes while you were talking. You said recalibration. I'd written realignment. I think this is a great opportunity for people to realign what they're doing, because this impost now, and I think it's forcing people's hands to go back and look at what is super actually for. And maybe some of these farming lobbies and, you know, people that are getting all up in arms about, you know, my farm's in super. Well, maybe it shouldn't be. Okay. Get it out of there, because it was never designed to do that in the first place. And the fact that too many superannuants die with huge amounts of money still in super, the whole purpose of it, and I say to my kids, you know, I'm planning to live to 105, but I said my super will be gone by the time I'm 91, 92. It's done that by design. Okay, that's the way it's designed to work. And they went, really? I went, yes, that's what it's meant to do. And I said, there are other, and you've made mention of some really good vehicles. There's company structures, there's family trust structures. There's a whole way of doing these things. And superannuation funds now, SMFs can have 6 members now. So we've got an ability to do, I guess, part of the thing that I see as well is education is part of that knowledge transfer, not just wealth transfer, but knowledge transfer. So I think realignment. So is that an opportunity that you at TAG are seeing, that you can go out and start talking to people saying, hey, this is good. This is actually good. Absolutely.
Well, I think it's a stretch saying it's good, but I think it is simply an opportunity.
Trying to put a silver lining.
I know. Let's make strawberry jam out of pig shit, as they say.
Okay.
But you're right. What it's about is actually making lemonade when there's lemons.
That's it.
That's my country Victoria
love it.
Colloquialisms coming out. But yeah, really, this is about simply taking what's been fed up to us and let's see if we can get the positives out of it. And I think having that recalibration, being able to get the right people involved, actually getting the family involved in some instances and getting the kids on board with what these decisions are is sometimes appropriate, sometimes not. So once again, that depends on the family dynamics. But the other thing, let's assume that we've made a decision as a family unit that we're going to pull some money out of superannuation. It doesn't end there. So once you've made that decision, then there's another raft of decisions that come off the back of that nobody's talking about or thinking about yet. It's, well, which assets do we pull out? Where does it come out of? Does it come out of the accumulation account? Does it come out of the pension account? If I've got multiple pension accounts, which pension account should I be taking it out of? These are decisions that haven't even been talked about in the media or anywhere yet, and yet they are going to be critical to to making sure that as we go through this strategically, we're making good decisions as we go along. Because if we go back and look back in 2 years' time and those decisions haven't been made, that can cost tens of thousands of dollars in tax because of it not being done effectively. So there's a lot more to it. And those decisions aren't necessarily something that an accountant is allowed to talk to you about.
That's the other point. One of the things, Michelle, I've now engaged a social media manager. She's 18. She's on my surf patrol, but I figured I needed some fresh blood and somebody that actually understands this space. People that are licensed to talk about this kind of stuff. We launched a TikTok channel because the first thing I say on my TikTok channel is, I'm actually licensed. So, and one of the things that we're talking about, and we'll make a big point, Michelle, you are licensed to say what you are saying, and you are fully qualified to say what you were saying. So
Correct.
I think if we strip away the hyperbole, we strip away the media fanaticism that's going on, particularly when people start playing politics instead of looking after people's best interests. Realignment and recalibration, I think, are really two excellent words that we can look at and take an opportunity.
Yep.
That won't stop me from hating taxing unrealised gains, by the way. I'll still point that out.
I'm 100% with you, Ray.
But on that, look, Michelle, we're just about out of time. Absolutely great subject today. Absolutely wonderful to have you back on the show. Let's have you back again as quickly as possible. And thank you for being on Dollars and Making Sense.
Absolute pleasure, Ray.